Welcome to the Deep Dive. We're here to give you the knowledge you need, fast and thorough, straight from the source material.
And today, we are really diving into the deep ends of luxury retail.
We're looking at the financial crisis that's gripping Saks Global. This is the parent company of Saks Fifth Avenue, Neiman Marcus, Bergdorf Goodman, all the big names.
Our mission today is, well, it's pretty complex. We need to unpack all this recent news about a potential bankruptcy.
Right.
We're going to trace the history, the deals, the financial engineering that got them here. And maybe most importantly, we have to analyze what this means for everyone else, the brands, the rivals, the whole retail debt market.
Okay, so let's start with where we are right now, the immediate picture. Because for Saks Global, the clock isn't just ticking, it's screaming.
It really is. The company is reportedly in deep talks about filing for Chapter 11 bankruptcy. They're calling it a last resort.
Which usually means it's the next resort.
Exactly. It's an attempt to restructure all this massive debt and difficulty under, court supervision. The urgency here is all about a very specific, critical liquidity problem.
Cash.
They are staring down an interest payment of over $100 million.
$100 million.
And it has to be paid by the end of December 30th, to be precise. If you miss that payment, that's a default. It's a trigger.
And the creditors can just call in the entire debt at that point? It forces your hand?
Completely. That's what pushes you into restructuring or, liquidation.
So $100 million interest payment due right after Christmas. That's the definition of a cash crunch. The company's public statements have naturally been pretty cagey.
Oh, of course. They're trying to calm the markets. They've confirmed they're exploring all potential paths to secure a strong and stable future.
Standard corporate speak for we're in trouble.
It is. It includes things like emergency loans, maybe selling off some assets. But even as they say, opportunities in the luxury market remain strong.
The balance sheet tells a very different story.
A completely different story. And this isn't random. It's all rooted in how the company was even formed. Saks Global, as we know it, is only about a year old.
It all came from that huge acquisition of Neiman Marcus Group,
right?
December of 2024.
That's the one. The $2.7 billion deal.
So that's what brought Saks Fifth Avenue, Neiman Marcus, Saks Off Fifth, and Bergdorf Goodman all under one roof. But the big question is, at what cost?
Well, the immediate cost was a mountain of debt. The deal put the new company under more than $4 billion in total debt.
$4 billion.
Now, they did get new financing, a big $1.8 billion asset-backed loan. But that level of debt, when interest rates are high and consumers are pulling back, it's just proven to be completely unsustainable.
And if you look at that $4 billion number, you can see why they're so desperate for cash flow. Which brings us to, I think, one of the most shocking parts of this story.
The vendors.
Saks Fifth Avenue has been chronically, systematically behind on paying the people who supply their goods.
And this is despite that massive merger and all that financing you just mentioned. We're talking about what? Hundreds of thousands, sometimes millions of dollars owed to over 100 different brands.
The stories are just wild. There's Ryan Babenzian from the brand Jolie. He's owed $15,000 from an order placed last year.
And the craziest part of that story, his product sold out. It had a 100% sell-through rate.
So Saks collected the cash from customers for the product.
And just never paid Jolie. It's incredible. And he's not alone. CTE Watchco is reportedly owed hundreds of thousands.
You can just feel the frustration from these suppliers. One executive said something like, how can you go out and buy Neiman Marcus for billions, but you can't pay me $15,000?
That's a fair question. It's gotten so bad that some brands like Jolie and the skincare company Solawave, they just gave up and sent the debt to collection agencies.
Just to try and get their money back. Wow.
And this all came to a head with this really controversial letter that Saks sent out to all its vendors.
Oh, this was something else. They basically acknowledged they were late on payments.
Right, they admitted it. But then they tried to dictate new terms. They promised to pay off the old debt from 2024 by the middle of next year. So maybe 2026.
A 2-year delay on payment, and then what, for new orders?
For new orders, they demanded 90-day payment terms, unilaterally.
90 days after you haven't been paying them at all? The arrogance of that.
Brands called it arrogant and disrespectful. You can see why. They felt like they were being forced to act as an emergency bank for this giant debt-ridden company.
So a lot of them just pulled back, right? They terminated the relationship or cut back on what they were shipping?
They did. But then the management response just made things worse.
This is where the threats came in.
Pretty much. A thinly veiled threat according to reports. They basically told brands, if you cut back your shipments, we will cut you from our stores entirely.
And at the same time, we're hearing that some of the really big vendors, the ones owned by powerful conglomerates or with personal connections to leadership, they were exempt from all this.
That's what the sources suggest. A clear two-tier system. One set of rules for the small, independent brands and another for the powerful friends of the company.
That kind of culture, it really starts at the top, doesn't it? We have to talk about the executive chairman, Richard Baker.
We do. He has this reputation as a real estate-born deal maker.
Yeah.
The criticism has always been that he's focused on financial engineering, on squeezing value out of the properties.
And not on the actual, business of retail.
Exactly. And his track record kind of backs that up. Just look at Hudson's Bay Company in Canada, which recently filed for Chapter 11.
Critics say that was years of neglect. The stores fell apart while he focused on the real estate.
And Lord & Taylor's the classic example. He sold off their iconic Manhattan flagship building for $850 million, years before the company finally went bankrupt.
So the pattern is always extract the real estate value first, let the retail operation wither.
That seems to be the playbook. And it's happening again. They've already announced they're closing the Neiman Marcus flagship in downtown Dallas.
They said it was because of failed lease negotiations,
which critics are calling a transparent excuse. Given the history, it looks a lot like a move to liquidate a valuable piece of property to generate quick cash.
Okay, so shifting over to the investor side of things, it's really clear they're preparing for the worst. You hear talk about a DIP loan. That's a huge red flag.
A debtor-in-possession loan, right? That is serious bankruptcy planning.
It's basically emergency money to keep the lights on during a restructuring.
Exactly. It lets you pay employees, pay for utilities, just keep the doors open while you're under court supervision. The fact that they're already discussing one tells you how close they think they are to filing.
And as we said, this isn't their first time using creative financial moves. They've already done these complex liability management deals.
That's right. They did that $600 million debt swap and the priming up-tier exchange we talked about earlier.
The deal where they basically let some bondholders cut in line?
Exactly. You move a select group to the front of the repayment queue, which pushes everyone else back. It's a move that really upset a lot of their investors. The value of the bonds held by the people left out just plunged.
It just signals that management will do whatever it takes to survive, even if it means burning some of their own capital providers.
It does. And in terms of raising cash, asset sales have been on the table for a while. They were looking at selling a minority stake in Bergdorf Goodman.
And they were floating a value of what, up to $2 billion?
Up to $2 billion, yeah. But the key part of that deal was that it only included the retail business. It specifically excluded the real estate, the super valuable Fifth Avenue property itself.
Which tells you everything you need to know about where the real value is.
It's in the bricks, not the business.
We have to put all of this in the broader context of what happened in retail in 2024. I mean, it was just a bloodbath.
A total retail apocalypse. You had this perfect storm of high interest rates, inflation, and consumers just getting really cautious about spending on non-essential goods.
And we saw some huge names go down. 99 cents. Only liquidated all 371 of its stores.
Red Lobster restructured and shed over 100 locations. Party City is looking at its second bankruptcy, and they're expecting to liquidate all 695 stores.
It's just a massive market event. And it tells us, I think, two really important things for the Saks situation.
First, when these companies go into Chapter 11, the ones who get hurt the most are the unsecured creditors.
The vendors we were just talking about.
Exactly. At Express, for example, unsecured creditors were estimated to get back maybe 10 to 15 cents on the dollar.
And in a full liquidation, like Rue 21.
They often get zero, nothing.
Yep.
So that's the kind of risk the suppliers to Saks are facing right now.
And the second point is that all these closures are just flooding the market with empty retail space.
Absolutely. Which creates a very clear set of winners and losers. While Saks is struggling, who's benefiting?
Their rivals, Nordstrom, Bloomingdale's.
Massively. All this uncertainty at Saks is a gift to them. They can gain market share. They can pick up the great brands that are fleeing Saks. It's a huge boon for their business.
All right, before we wrap this up, it's time for our not financial advice segment. This is where we pitch a, let's say, outrageous but plausible trade idea based on everything we've just discussed.
Okay, so let's connect the dots here. We've seen this unprecedented wave of liquidations in 2024. You got hundreds, maybe thousands of empty boxes left behind by 99 cents only, Party City, Cons Home Plus.
A huge oversupply of commercial real estate, especially in those secondary markets. So what's the trade?
The thesis is based on that continued glut of retail real estate.
Right.
The play would be to short any real estate investment trust, a REIT, that is heavily exposed to those kinds of distressed regional malls.
Especially the ones that used to be anchored by one of these now defunct stores.
Exactly. You're essentially betting against a quick recovery for that kind of retail property. The idea is that all this available real estate is great for discount operators like DJX, Burlington, Aldi.
Right. They can swoop in and get amazing deals on rent in great locations.
They're cherry-picking the best spots. But it's terrible for the REITs that are just sitting on all these empty, unproductive buildings. You're betting that the recovery in that space has a long, long way to fall still.
That is a really interesting way to connect the decline at the top of the market with the chaos at the bottom. Okay, so to recap the core takeaways here.
The Sachs global crisis is really a perfect storm. You've got this massive debt from financial engineering, you have macroeconomic pressure, and critically, this complete breakdown of trust with their suppliers.
And it's all coming to a head with that $100 million payment due at the end of the year.
Which leaves us with a final, I think, provocative thought for you to chew on. What is the actual long-term future for the luxury wholesale model, for the Saks and Neiman Marcuses of the world?
When all the big luxury brands, the Guccis, the Pradas, are so focused on their own direct-to-consumer channels.
Exactly. If these department stores are constantly being forced to choose between paying their massive debt bills and paying the very suppliers who stock their shelves, how can they possibly survive? How long can that model actually last?
A profound question about the future of how we buy luxury. If you want to dive deeper into this or any other market event, please check out our next deep dive. Thanks for listening.